Let's use this comment here to learn the difference between competitive bidding and non-competitive bidding when it comes to treasury bonds. Now, non-competitive bidding is where the investors tells the Central Bank of Kenya they are willing to take the yield that will be determined by the market. They are willing to take the yield that is determined by the market, so they don't quote any yield at the point of bidding. Now, on the other hand, non-competitive bidding is where investors are given a chance to dictate or to state their desired yield at the point of bidding. Now, once a bond is released, there are three things that comes with that particular bond. Three papers. That is the prospectus, the one that is showing the information. Then there is the one that is showing the different possible yields and the different possible prices, and it is the one that I have here. Now, from your observation or from what you can see on this list, as the yield goes up, the price of the bond is going down. So this is what happens. For competitive bidding, I'll have a chance to quote my desired yield, and we have seen that the yield is very important because it is determining the price of the bond. So if I'm doing a competitive bond bidding, I'll try and quote as high yield as I can, so that the price that I'll have to pay for that particular bond to be very low. But this is the catch. After the bidding process is done, and the Central Bank of Kenya determines the market average yield, so they'll pick, let's say, for example, let's assume the yield is determined to be the same as the coupon for the first bond at 12.5%. At 12.5%, it means that the price of that particular bond will be 99.9755%. But if I was bidding competitively and I bidded 12.75%, I said I want a yield of 12.75%, and my bid was accepted, I will not pay 99.9755, but I will pay 99.0656. You see, me quoting a higher yield will ensure that I pay a price that is a bit lower than what the non-competitive bidders will pay. But here is the catch. After the yield has been determined, there is a rate that is determined that any yield that is out of that range will not be accepted. Perhaps the yield is determined to be 12.5, and the Central Bank of Kenya says will not accept any bid which yield was above 13%. This is just an example. We are not accepting any bid whose yield was above 13%. So if you had placed your bid at 13.1250 and the cutoff has been put at 13%, your bid will be rejected. So in case you are very serious about investing the money you have, I think the best way is going non-competitively, that is bidding non-competitively, because you might try getting a slightly lower price, but you end up your bid being rejected because no one can be able to predict the market average yield before the bidding is done. So that is the difference between competitive bidding and the non-competitive bidding. So it is the yield that they are given a chance to determine, and the yield will only affect the price. Otherwise, the coupon is fixed at 12.5%, and that will not change for both the non-competitive and the competitive bidders. The only catch is that the competitive bidders has a chance of paying less for the bond initially, but when it comes to coupon payments, they will receive the coupons at the same rate. I hope it's clear.